Good afternoon. Welcome to Retirement Matters. My name is Sean McDermott. I'm the president of Summit Investment Financial Planner. I'll be hosting the webinar this afternoon. Our main speaker will be Russell Rogers. A couple of things before we begin. I'd like to start with one of the interesting statistics I recently found from Wells Fargo. They said that the average middle-class American has saved only $20,000 for retirement. And they said that half of those individuals between age 50 and 70 have only saved $25,000 for retirement. This is a pretty alarming statistic, and we've started these webinar series on the third Thursday of every month to help individuals so they don't end up in this retirement trap of not having enough money. So a couple of things I'd like to go over before we begin into the main part of our presentation. You'll see on your screen there's going to be kind of your a red arrow portion there that you can actually click on if you want to reduce the size of the menu items. And then also a little bit lower in that menu bar there, you can see an area that you can type in chat questions. So if you do have any questions as we're going through the material, feel free to type them in and we'll try to address some of them a little bit later on in the broadcast or maybe during the broadcast. We're going to try to stay within a 30-minute time horizon here this afternoon, but if you need to log off, we'd really appreciate it if you could fill in that evaluation form for us. Which you'll find in the handouts. Also in that dashboard there, you can see that we have included some handouts that follow along with the slides that we'll be presenting, and you can download those or open them up. And so that's all kind of the announcements, and without further ado, we'll jump right into it. Our main speaker this afternoon is going to be Russell Rogers. He specializes in retirement income planning. He does a lot of retirement projections and forecastings for Summit Investment Advisors. He's also in charge of supervision and compliance. He's a registered Series 24 principal. And Russell also finished off a successful kind of career with the Minnesota National Guard, where he finished at the rank of captain. Russell lives up in the northern part of the suburbs here and has 2 children and a wife. And as far as a little bit other interesting things about Russell, he enjoys playing guitar, and he's an avid fisherman. So without further ado, I'll let Russell take it over, and I'll be maybe interjecting as we go throughout the workshop. Russell, take it away.
Hey, all right, thank you, Sean, for the introduction. And so we're going to look at 4 aspects of retirement living during the course of this presentation. Okay, I just got to move something over here that's in my way. Okay, and the first item we're going to review is the tale of 2 retirements. The second is a look at healthcare and Social Security. Next, understanding inflation and spending. And finally, strategies for retirement living. So let's dive right in. The tale of 2 retirements. The timing of your retirement could potentially make a difference in your retirement living. In this example, let's take a look at what we're going to call a bull market retirement. In this instance, a hypothetical couple retired on January 1st, 1991, with retirement savings of $500,000. They invested their entire portfolio into the S&P 500 index fund, and no, that probably isn't a good idea. They decided to withdraw $70,000 per year and increase their annual withdrawals by 3% to account for inflation. The chart on the left shows that despite their withdrawals, their account balance rose to nearly $770,000 by the end of 2000. The couple withdrew $802,000 during the 10-year period. By the way, the initial withdrawal rate in this example is 14%, which is extremely high. Now, all we did in this next example was change the date range. That's it. Let's call this a bear market retirement. In this example, the couple runs out of money in the 7th year. During the 7-year period, the couple withdrew approximately $460,000. So what is the takeaway from these examples? We're not suggesting that you plan to retire at the beginning of a long bull market, even though that'd be really nice, wouldn't it? Because nobody knows what the stock market's going to do. What we are suggesting is that you plan. Plan in order to increase the potential for successfully reaching your retirement goals. I'm going to talk more about our planning process more in the final section of this presentation. The next section we're going to explore is called a look at healthcare and Social Security. At the end of 2014, according to the most recent trustees report, some 59 million Americans were receiving disability, survivor's benefits, or retirement benefits from the Social Security system. The total cost was $848.5 billion. 166 million people paid payroll taxes into the system. To put it another way, there are now only about 2.8 persons paying in for every person receiving benefits. Another thing I wanted to talk about is the legislation that was recently passed. As you may or may not have heard, there wasn't a lot of lead-up or announcements, and all of a sudden it passed and it's done. And what they did was they took away some options for collecting Social Security benefits. And I want to highlight an example. My dad, who's just turned 65, he's also a financial planner. So he's in the upper Michigan, and he was actually planning on using the strategy that was taken away by that recent legislation. So my mom started collecting at age 62, and she has a real small benefit because she was a homemaker for most of her adult life. So she's collecting her benefit now, and the plan was at age 66 next year, my dad was going to file and suspend. And he was going to do that to allow my mom to go on her spousal benefit, which would be 50% of my dad's full retirement age benefit amount. And by suspending, my dad was going to get delayed retirement credits from age 66 to 70. That's 8%. And then he was going to go on his benefit at age 70. So he can't do that anymore. If he wants my mom to be able to collect her spousal benefit, he has to file. He can't file and suspend. So we talked about it. I called him on the phone as soon as I saw that, and it sounds like he's probably just going to claim his own benefit at age 66. So if you need to take another look at your Social Security claiming strategy, let us know because we can help.
Yeah, Russell, I just wanted to add in here that the Social Security laws, the Congress will be having a final vote on this as to the start date for them, and we're expecting sometime in the first quarter. They're thinking maybe by the end of March these laws will be changing. So for people that are planning to draw Social Security benefits within the next year or so, you might want to take a good look at it and make some decisions either before January 1st or really early during the year next year, and you'll be grandfathered into the old laws that exist right now. So if you're close to the age 65, 66, or planning to draw benefits real soon here, let us know, and maybe we can help you work through whether it's beneficial to start a little bit sooner than you expected. Okay? Thank you. Go ahead.
All right, thanks, Sean. So on this next slide, a landmark study found that 40% of adults underestimate the average life expectancy by about 5 years. To put it another way, most adults think they're going to die younger than the statistics indicate. According to a published report from the Society of Actuaries, if a couple reaches age 65, they stand a 50% chance that one of them will live to age 92. and a 25% chance that one of them will live to age 97. When it comes to retirement living, increasing healthcare costs are a concern for the majority of people. One survey found that 83% of pre-retirees polled were either not confident or only somewhat confident that they would have enough money to pay for medical expenses in retirement. All right, now it's quiz time. Okay, question.
Excuse me, Russell.
Yes.
Yeah, are you going to tell them all about the prizes if they guess these three right, all three right?
An all-expense fishing trip to the Boundary Waters. That's what's at stake here.
Oh, there we go. Okay, yeah, they have to get them all right. And I don't know how they're going to prove to us they get them right. But just real quick thing on this on the healthcare expenses. We're seeing a lot of that right now, where healthcare premiums for pre-retirees are going up by 50% next year, and for people that are working right now, their deductibles are continuing to increase. For current retirees, where the big expense lies right now is they're needing to pay for Medicare Part B. In addition, they have to have a supplementary Medicare policy, and then plus, they're going to have co-pays and deductibles and so forth. So all these expenses are adding up to, could be anything from $250 a month to, $750 or $1,000 a month. And so it's something that's you definitely need to take a look at it, are the increasing healthcare costs and how you're going to fund those during your retirement. So, okay, let's go ahead with the quiz.
All right, question number 1. What is the life expectancy of a 65-year-old in the U.S.? A, 17.8 years, B, 19.2 years, C, 20.9 years. Okay, the answer is B, 19.2 years. Okay, question 2. True or false? Healthcare costs are rising twice as fast as inflation. This one seems a little tricky. We know they're going up a lot. Okay, let's see what the answer is. The answer is false, because healthcare costs are rising 4 times faster than inflation. Wow. Okay. Question number 3. Over the remainder of their lives, 65-year-old retirees can expect to spend how much in healthcare? A, $252,000. B, $327,000. C, $369,000. All right, the answer, it's C. 65-year-old males are expected to spend $369,000, and 65-year-old females are expected to spend $417,000. Okay.
That was a pretty good quiz, Russell.
Unfortunately,
yeah, go ahead.
It's not on here. It's not on the slide presentation, okay? Question is, who is going to win this weekend when the Packers face off with the Vikings? That's what I want to know. Any ideas on that?
You can go ahead and type that into the chat area. We'll take a poll on Packers or Vikings. Okay, go ahead and chat that in if you guys want to. But unfortunately, nobody won our quiz for the all-expense trip paid to the Boundary Waters, and with Russell Rogers, right? You forgot to add that.
That's right. That's right.
All right.
Okay, let's move on to the third area, understanding inflation and spending. We all know that inflation exists. Different goods and services have different inflation rates. Some are high, as is the case with healthcare costs. Some are low. I drove into work this morning and I noticed the gas is under $2 per gallon, which is really good for me because my vehicle has a V8 engine and it doesn't get very good gas mileage. Okay. Another insightful exercise is to see how your withdrawal rate may affect your retirement. This illustration shows a $1 million account earning a hypothetical 5% a year, withdrawing $80,000 per year and increasing withdrawals by 3% to account for inflation. The account is projected to exhaust in 15 years. If annual withdrawals are reduced by $40,000 and increased by 3% a year for inflation, the account is projected to have more than $950,000 after 20 years. The point is, high withdrawal rates are usually not sustainable. And we all know that people are living longer nowadays. Think about it. If you want to retire sometime, maybe age 60 or age 65, and there's a good chance, you might live to be age 90, that's a long time that your retirement assets have to last in order to provide you with an income stream. And so we want to make sure that we're paying attention to those withdrawal rates. We want it to be sustainable. The final topic we're going to review is called strategies for retirement living. At any time, evaluating your asset allocation is important. However, in retirement, asset allocation is even more important because instead of adding to your investments, you're most likely taking withdrawals. This chart shows the performance of 3 major asset classes over the 20-year period. And as expected, stocks have the highest return, but also have the most volatility, while cash has the lowest return and also the least volatility, and bonds right in between. Taking withdrawals from the right assets and having the right mix is paramount. To illustrate this, I'm going to give you an inside look at how we develop a plan for income distributions in retirement. Now first I want to say a word about that. Many of you watching today are clients, and for many of you, you can attest to the process because you've gone through it and you know the value of having that visualization where you stand. But I also realize that maybe some of you haven't had a projection done, or maybe it needs to be updated. Maybe it's been a few years and you want to see where you stand. So I'm going to go over that process a little bit more here. Here's a list of information that's needed in order to put together a retirement projection and income plan. The projection needs to be accurate, thorough, and realistic in order to be useful, and must take inflation and taxes into account. Once all the information is added into our software, we generate a detailed retirement projection. The cash flow report is then used to show an overall picture of the assets over time. Here we see that the clients are starting with just under $500,000 in portfolio assets and have a need of $60,000 net in total retirement income. This is indexed at 3.74% for inflation. Now this is fairly typical. I run a lot of these retirement projections, and in this example, this is going to be pretty typical of what we see, where somebody needs maybe $5,000 per month net in retirement income. They may have a pension. In the case of this example, I show both couples have a pension, and also show them collecting Social Security. Maybe your home is paid off at that point, and you're going to do some traveling, but this is a very reasonable dollar amount here for what we see in all the different projections that we end up running here. Okay, here we see the numbers behind the previous chart. The clients will receive a substantial amount of their net retirement income needs from Social Security benefits and pensions. There is, however, a shortfall, and the clients will need to rely on withdrawals from their portfolio. If we look at the second column in from the right labeled net cash flow, we can see the amount the clients will need to take from the portfolio. We have a schedule here. We have a distribution schedule. How neat is that? The parentheses show that the dollar amounts are negative. And these are gross distributions because the software has already calculated the tax liability. If we take the first 5 years of retirement, so 2016 through 2021, we know that the clients will need to take a total of approximately $72,000 from the portfolio. Now that we know that the clients will need approximately $72,000 for the first 5 years of retirement, we can begin to develop the allocation. This diagram shows a strategy for income distribution. Income comes out of bucket 1. And based on our example projection, bucket 1 should have around $72,000 worth of cash, high-quality bonds, and other short-term investments. Buckets 2 and 3 are for future income needs and can be invested for more growth potential. This is a concept and not a specific investment recommendation. I want to be clear about this. The types of investments that we would use and the amounts, that's going to vary from person to person based on a number of factors to include, your total asset level, your time horizon, your tax situation, and your risk tolerance, and several other factors. So why is it important to have an income plan? Why is it so important that the first 5 years of retirement income are earmarked in bucket 1? Because when we experience a stock market decline, you do not want to be selling the wrong kinds of assets to fund your retirement distributions. By having 5 years worth of retirement income invested in bucket 1, you essentially have a 5-year buffer from having to sell the assets in buckets 2 and 3. If the S&P 500 drops 10%, like it did at the end of the summer, the value of buckets 2 and 3 are likely to be down substantially, while the value of bucket 1 may be down less or even up slightly. All right, you may remember this slide from our mid-year outlook. And we have an opportunity to hear from many different economists, and we've listened to them from some major firms, including JP Morgan, BlackRock, LPL, and others. And right now, there's a consensus that the U.S. economy is nowhere near a recession right now. We are in the mature stages of a bull market. And although we expect to see continued volatility, we also expect continued growth in the stock market. As always, we need to be disciplined and stick with the plan. If you'd like to get started on a plan, or perhaps you just need to update one, please contact our office. Here's our contact information.
Okay, Russell, thank you. And again, if you have any questions, feel free to email Russell or Sean at summitinvest.com. And this afternoon we'll be hosting the same workshop at our conference facilities here in Roseville at 4 p.m. and we'll be serving food and beverage this afternoon. And with that, if you could please do the evaluation forms and send those on to us. We'd like to, get a little bit of feedback on these workshops and also find out if there's any other topics or suggestions that you have for us. With that said, there's not a lot of comments on who's going to win this weekend other than the one that I put in, Russell, and the Vikings. They're going to win, and so everybody have a happy Thanksgiving and cheer for the Vikings, right, Russell?
Yeah, I'm a Packer fan, so I'm in enemy territory here.
All right, probably not so outnumbered as you think. Okay, thank you, everyone. Have a great day.
Thank you.